Today, central banks under the microscope. Hello again, it's Martin North from Digital Finance Analytics, working the latest post covering finance and prop news with a distinctively Australian flavour. Today I start a series of posts examining central banks, who owns them, who are they accountable to, and how are central bankers across the developed world connected. Although different central banks have different objectives, two of the most common are promotion of monetary and financial stability. Monetary stability can be defined as low inflation, while financial stability can be defined by the absence of financial crises. Later, we'll also question whether this inflation objective makes any sense at all. We know that recently central banks have been cutting rates and doing QE, and of course last week in Australia the RBA here discussed unconventional monetary policy, on one hand saying it probably won't be needed, but if it is, then all bets are off. And the role of central banks is an important and wide-ranging subject, and one which it seems to me few want to touch, especially in the context of negative interest rates and more QE. But it's worth noting that in the past couple of weeks, several central banks have broken rank and are now questioning their current trajectory. The ECB warned that very low interest rates, coupled with the large number of investors which have gradually increased the duration of their fixed income portfolios, could exacerbate potential losses if an abrupt repricing were to materialise. The Federal Reserve cautioned that business debt levels are high compared with either business assets or GDP, with the riskiest firms accounting for most of the increase in debt in recent years. Around half of investment-grade debt outstanding is currently rated in the lowest category of the investment-grade range, BBB, near an all-time high. And the German Bundesbank said that negative interest rates are encouraging banks to take on ever greater risks, expanding their lending to relatively high-risk businesses while simultaneously reducing their provisions. And German lenders have also increased their exposure to the fast-growing domestic real estate market, while the Bundesbank considers house prices in many cities there overvalued by 15 to 30%. And Banque de France has called out the unchecked rise of corporate debt in France. By 2018, 123 of the 215 groups under review had made an external growth investment, said the Bank of France's report. Many of the acquisitions have taken place since 2016, when the ECB embarked on its corporate debt purchase programme, which made it much cheaper for corporations to issue fresh debt. As the report notes, the burden of this debt will have to be covered by the future revenues released from these acquisitions. In some cases, however, they say, there is a risk that anticipated future revenues may be overvalued. So to start, it's worth thinking about the ownership structure of central banks, not least because we get many contacts from followers who assume the RBA is privately owned. But in fact, around the world, central banks have a number of different ownership structures, and later we will discuss the RBA, which states the Reserve Bank of Australia is an independent central bank with responsibility for monetary, financial system and payment system policies and other financial matters. And by the way, it generally pays a dividend back to the federal government. At one end of the spectrum are central banks like the Bank of England, who are wholly owned by the public sector. At the other end are central banks like the Banca d'Italia, whose shareholders are wholly private sector entities. And there are central banks like the Bank of Japan, which lay in between. And it's worth highlighting that ownership and control, in theory at least, may not necessarily be totally linked, though of course there may be a suspicion if a central bank is privately owned that it may well be acting more for its owners than the community. That said, the purpose of most private sector corporations is to produce profits for shareholders, whereas central banks typically have statutory mandates based on economy-wide goals, for example, price stability, financial stability, and market functioning. This is irrespective of whether central banks are wholly owned by government or something else. Yet this does lead to questions of accountability and who oversees the central bankers, as often they seem to be able to avoid scrutiny. Indeed, the Murray Financial Systems Inquiry suggests that the RBA and regulators should be tested by a separate entity to ensure their efficacy, a recommendation which was dropped like a hot potato after the report landed. And as a recent article in the Banking Underground series from the Bank of England highlighted, in the early 20th century there was roughly an even mix of central banks with private sector and public sector shareholders. But that changed mid-century. Some established central banks, like the Bank of England, were nationalised. At the same time, almost all of the central banks created in post-colonial states were established fully state-owned. So by the end of the century, just a handful of central banks with private sector shareholders remain. While state-owned central banks now predominate, some central banks still have forms of private sector shareholding. These include central banks in the United States, Japan, and Switzerland. And they can be classified according to whether they are owned by the government, private sector banks, other private sector shareholders, or some combination of these. And other private sector shareholders means individuals and/or non-bank private sector institution. The European Central Bank, the ECB, represents a fourth ownership model not adequately captured, as it is established by treaty among EU member states. Besides the ECB, other supranational central banks include the Eastern Caribbean Central Bank, the Bank of Central African States, and the Central Bank of West African States. Now we can look at more detailed information on central banks not fully owned by governments. Ownership models may vary considerably among those 9 central banks, although the central banks of Japan, San Marino, and Turkey have some private sector shareholders. The majority shareholder is still the state. In Belgium and Switzerland, around half of the shares are held by the government. But in contrast, the American, Italian, and South African governments have no formal ownership stake in their central banks. The Bank of Greece presents a more mixed model, although it is worth bearing in mind that it, along with the Belgian and Italian central banks, are members of the euro system. The shares of central banks in Belgium, Greece, Japan, and Switzerland are publicly traded on stock exchanges. And we also see how the remuneration of their private sector shareholders varies. In some cases, like the US Federal Reserve, the amount paid to shareholders is fixed, such that the dividend closely resembles a coupon payment on a bond. In other cases, as in Turkey, the remuneration is variable and discretionary, although even here it is capped. And a recent paper finds that central banks with private sector shareholders do not differ from central banks with only public sector shareholders, either in their profitability or in the share of profits they distribute to shareholders. But the takeout from today is that there are various models of central bank ownership. The RBA is ultimately funded by government and pays a dividend to government and has no direct private shareholders. Central banks in some other countries are quite different. And next time we will look at the role of the Bank for International Settlements, the banker's banker, and more closely at the RBA, its mandate, and to what extent it is held accountable for its actions. The results may well surprise you. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.